This is the LexBeyond podcast by Lexicon Labs. I'm Lex.
And I'm Bianca. You know, if you're watching the financial landscape right now, I mean, the crypto volatility, the explosion in sports betting, all these chaotic enforcement actions, you might just feel like you're caught in some kind of financial thunderstorm. It's just relentless. But last time we challenged this idea that all the chaos is, random. We put forward this thesis that the multi-trillion-dollar turbulence we're all seeing really just stems from the muddy, chaotic definitions of four simple words.
That's exactly it. That systematic risk, the massive wealth transfer, the stalled innovation we talked about, it all comes down to the ambiguity around investing, speculation, gambling, and gaming. The lack of precision is costing the global economy. I mean, dearly. But here's the pivot, and it's a crucial one. This problem, which was created by these legal and linguistic gray areas, it has to be solved by legal and linguistic precision.
Absolutely. So we laid out all those massive costs, the wealth transfer, innovation just suffering, competition being destroyed. But today, we're flipping the script. Our mission for this deep dive is to go from problem to solution. We are going to explore 4 distinct legal avenues, all based on existing law, that give us a roadmap to fix this system from the inside out.
And this whole strategy is guided by a core philosophy.
Yeah.
You live by the law, you die by the law. The same flexibility that these organizations use to exploit the gray areas can be turned around to establish clarity. We don't actually need new laws. That's the thing. The power's already there, sitting in the existing statutes, just waiting for, rigorous and clear-eyed enforcement, all based on a proper analysis of those 4 definitions.
Okay, that structural clarity starts right now. So let's jump in. Avenue number 1, securities laws. The source materials we reviewed it's a really strong, almost confrontational claim right out of the gate. They say you cannot invest in crypto, you can only speculate on it.
And that's the necessary legal starting point. Historically, securities laws were created to manage an information asymmetry. The legal term investment contract is designed to protect people who put money into an enterprise to make sure they get full and fair disclosure. Back in the 20th century, that meant, providing detailed company data so investors didn't accidentally think they were investing when they were really speculating on some shaky business.
But the world is totally different now.
It absolutely is. In the 21st century, the disclosure problem has evolved. The essential disclosure for a crypto token isn't about the company's financials. It's about the very nature of the asset itself. The disclosure needs to tell the buyer, point blank, that what they are buying at any price, whether it's $1 or $60,000, is legally speculation. It doesn't generate cash flow in the traditional sense, so you're just betting on price appreciation.
Okay, but hold on. This is where the academic work from Lexicon Labs really starts to push back on the common narrative. They suggest that buying crypto tokens, and this includes something as decentralized as Bitcoin, can and should be a securities transaction. That seems counterintuitive. If Bitcoin is decentralized, how can you possibly argue it meets the legal standard for a security?
To get there, you have to dive into the legal mechanism itself, the Howey test. Now, for listeners who aren't steeped in securities law, the Howey test traditionally asks 4 questions to see if something's an investment contract. 1, an investment of money. 2, in a common enterprise. 3, with an expectation of profit. And 4, to be derived from the efforts of others.
And the common wisdom is that you have to check all 4 of those boxes.
Exactly. The popular view treats Howey like this rigid, conjunctive 4-part checklist. But the modified Howey approach, which is rooted in a deeper reading of the law, says that Howey is actually meant to be a flexible economic framework. Think of it like a set of toggles that you adjust to the economic reality of the situation.
Okay, so what's the key modification here? What's the toggle that brings crypto under the SEC's purview?
It all focuses on that last prong, the effort of others prong. Historically, that prong was created for situations where an asset generates cash flow, like dividends from a stock or profit sharing. The crucial insight of the modified Howey test is this. If the underlying asset, like a crypto token, doesn't generate cash flow, the traditional effort of others prong is just. It's turned off. It's not triggered. So the analysis moves right back to the first 3 prongs.
And why is cash flow the deciding factor there?
Because without cash flow, the whole mechanism for how you profit is fundamentally different. If you buy a stock expecting a dividend, you're relying on the management, the effort of others to generate that cash. If you buy a crypto token, your profit relies almost entirely on the secondary market.
On the next buyer paying more than you did.
Precisely. That distinction changes the legal nature of the risk and what the investor's expecting. By turning off that cash flow prong for non-cash flow assets, the legal path to labeling crypto as a security and therefore a speculation, it becomes incredibly clear.
Wow, that's a fundamental reframing. So the big implication here is that the SEC's role actually shifts. It doesn't need to regulate the entire decentralized technology. It just needs to become a label regulator, a
Yeah.
bit like the FDA, just ensuring unambiguous clarity. This token is speculation. Label it that way. Okay, Avenue 1, settled. Let's move to Avenue number 2 then. The Commodity Exchange Act, or CEA. This is how we start to untangle the betting conundrum. This connects all the way back to the 2008 financial crisis and the Dodd-Frank Act that followed, which gave the CFTC a lot more regulatory authority. They were given specific power to shut down contracts, event contracts, if they involve gaming.
And that one word, gaming, is the linchpin for the entire sports betting fix. Depending on how you interpret it, the vast majority of the prediction market business, which uses these event contracts to let people bet on outcomes, is suddenly at risk. Lexicon Labs argues that Congress, when it used the word gaming in the CEA, didn't mean skill-based entertainment or daily fantasy or some new kind of betting. They meant gambling.
Okay, but how do we define that legally? I mean, in the context of the CEA.
The interpretation rests on a principle called the economic purpose test. Now, Congress mostly repealed this back in 2000, but the source material argues it remains the guiding legal principle for these kinds of contingent event contracts under Dodd-Frank.
Let's break that down for everyone listening. Economic purpose test sounds like some dense legal jargon.
It is, but the principle is actually pretty straightforward. The EPT was designed to make sure that futures and commodities markets served a legitimate economic function, hedging or price discovery. They couldn't just be tools for pure payoff betting. So if a contract has an actual tangible economic use, like a farmer hedging against the price of corn it passes, if it's just designed for two people to bet against each other on some future outcome with no real benefit to the market, it fails.
So if the CFTC applies this old but guiding principle to today's prediction markets, what happens? What's the practical fallout? What's left standing?
Well, most prediction market business just goes poof. If you're betting on whether a celebrity will attend an awards show or if a meme stock will hit a certain price, there is zero economic purpose there.
Right.
They're just pure contingent bets. The contracts that would remain legitimate would be ones that truly serve a national economic purpose and aren't contrary to the public interest. So things based on macroeconomic indicators.
Like GDP data or unemployment rates?
Exactly. Contracts tied to GDP, unemployment, maybe a reliable inflation index, things like that.
And crucially, what does this do to the sports betting market that uses these kinds of contracts?
Sports event contracts. Those that resolve based on the outcome of a game, they're specifically out. The sources are very clear on this. If the outcome is based on a sporting contest, it cannot pass the economic purpose test. And unlike state-regulated casino gambling, which state legislatures have specifically made legitimate, Congress has not legitimized sports betting in futures markets through the CEA. If America really wants widespread sports gambling through these markets, Congress is the only body that can supersede the current law's intent to prohibit gaming that lacks economic utility.
Wow. Okay, so the betting fix essentially shutters most of these non-economic prediction markets by enforcing precision on one word, gaming. But that kind of massive regulatory change leads directly to our next problem, doesn't it? Competition. Which brings us to Avenue number 3, the Lanham Act.
Yes. Because the ambiguity we've been talking about doesn't just confuse consumers, it creates a completely unlevel playing field. You have regulated businesses fighting with one hand tied behind their backs against these unregulated or ambiguously defined players. That is unfair competition, and that is precisely what the Lanham Act targets.
Can you describe that competitive dynamic, the one being exploited by this linguistic vacuum?
Sure. Take the gaming world. Every single dollar that goes to a daily fantasy sports operator or a sports event contract is a dollar that's not going to a heavily regulated licensed casino. The unregulated dollar is just easier to spend for the consumer. I mean, you can bet from your couch instead of driving somewhere. And in finance, capital that flows to these poorly labeled crypto tokens instead of legitimate IPOs or established markets. Well, it means real innovation suffers. People are choosing, in effect, fake investing over real investing. And that hurts the companies that actually need capital to survive and execute on their missions.
So how does the Lanham Act turn that unfairness into a legal argument that actually works?
The Lanham Act is all about misrepresentation. A regulated entity, let's say a casino, can argue that a competitor who's exploiting a loophole is mislabeling their product. For example, a regulated casino could sue a daily fantasy sports operator. They could claim the DFS operator mislabeled its product as skill-based entertainment or gaming when it legally functions as unregulated gambling. This mislabeling confuses consumers about the risk, about the legality of the product, and that causes the casino direct financial harm by siphoning off market share.
Ah, so it completely shifts the battleground. Instead of just waiting for the government to step in and regulate, the regulated industry can become the enforcer through civil lawsuits.
Correct. The law allows the injured party, the legitimate business, to sue the loophole exploiter for essentially false advertising and unfair competition. It's a really powerful tool for forcing definitional clarity across the entire competitive landscape.
Which brings us to our fourth and final avenue. And we're circling back to securities laws here, but focusing on the investor fix itself through public company disclosure requirements.
Right. This is all about accountability for publicly traded companies. If they're holding significant crypto assets on their books, or if they operate prediction markets, and they are not adequately disclosing the legal risk that comes with those ventures, they are violating existing disclosure requirements.
What kind of risk are we talking about specifically?
The risk that their crypto holdings could be deemed unregistered securities, or the risk that their prediction market operations could be ruled illegal gaming under that CEA interpretation we just talked about. If a company fails to disclose that massive potential liability to its shareholders, the investors themselves can sue the company.
So it uses the disclosure rules that are already on the books to enforce market precision. As Matt Levine is fond of saying, everything is securities fraud. I mean, that quote really highlights the latent power of existing disclosure rules if they're just properly enforced against this kind of ambiguity.
Exactly. So what you have are four enforcement mechanisms. The SEC using the modified Howey test, the CFTC enforcing gaming under the CEA, regulated businesses leveraging the Lanham Act, and investors pursuing disclosure failures, all of them triggered by just clarifying four ambiguous words.
Okay, let's synthesize this for everyone listening. We've established that the cost of this linguistic ambiguity is measured in trillions of dollars and stifled innovation. So what are the two non-negotiable conditions for people to be able to spend their money as they wish, but, within a functional, transparent system?
The first is clarity. People need to know exactly what they're getting into. Crypto has to be legally labeled as speculation, not investing, and certainly not gambling. The SEC's role here is to be that label regulator. The second is legitimacy. The activity itself has to be legitimate under the law. State-regulated casino gambling is legitimate, but future market betting on contingent events, especially sports, is argued to be illegitimate under the existing framework of the CEA's gaming prohibition. It's about enforcing the laws we have, not inventing new ones.
So this analysis gives us the structural language and the specific legal tools we need to bring precision and transparency back to the market. And not by drafting a single new piece of legislation, but by rigorously enforcing the laws we already have on the books.
We've laid out how precision in just those four words, investing, speculation, gambling, and gaming, can trigger four distinct legal enforcement mechanisms that provide a comprehensive solution for crypto, for betting, for competition, and for investor protection.
So if this level of definitional ambiguity is causing systemic chaos in the global economy, costing trillions in wealth and innovation, we want to leave you with one final provocative thought. What specific assumption in your own personal financial life is currently being obscured by fuzzy definitions?
Yeah. Take a moment and ask yourself, what are you calling an investment that, if you really dissect the risk and the precise mechanism for return, might actually be speculation? Are you maybe confusing a savings account with a high-risk cash flow generator? The power of linguistic precision, it really begins with the clarity you bring to your own financial decisions.